We are covering these 8 top actively traded stocks that are bullish today. While watching price actions, let us inform you our review on DNN, Denison Mines Corporation, a key player in uranium exploration and development in Canada's Athabasca Basin, just made a strategic addition to its leadership team. The company announced the appointment of Ken Hartwick, the former CEO of Ontario Power Generation, OPG, to its board of directors. This is a notable move, given Hartwick's extensive background in energy infrastructure and nuclear power, both areas that directly align with Denison's long-term growth plans. For investors, this signals a strong vote of confidence in Denison's future. Hartwick's leadership at OPG, one of North America's largest clean energy producers, gives him deep industry expertise in nuclear power markets, regulatory frameworks, and energy policy, critical areas as the global demand for uranium rises. His insights could help Denison navigate industry shifts, forge strategic partnerships, and position itself to capitalize on the increasing push for clean energy and nuclear power. With uranium prices trending upward and nuclear energy gaining momentum as a key solution for a low-carbon future, having someone like Hartwick on board could prove invaluable. This appointment strengthens Denison's position in the market and could serve as a catalyst for long-term growth. Investors should keep a close watch on how this leadership shift plays into the company's broader strategy. Our review on SNAP. Snap Incorporated, the company behind Snapchat, saw its stock jump 5.5% before settling at a 2.1% gain, as the broader market reacted to the Fed holding rates steady at 4.25% to 4.50% and hinting at 2 cuts later this year. That's a relief for investors who feared a more aggressive stance. But the Fed also downgraded economic growth expectations while raising its inflation forecast, setting the stage for potential stagflation concerns. For Snap, the move signals investor sensitivity to macro conditions rather than any major shift in the company's fundamentals. The stock has been a roller coaster, with 23 swings over 5% in the past year. But today's reaction suggests the market views this as meaningful but not game-changing. The last big move was nearly a year ago when shares surged 27.5% on strong earnings, driven by better-than-expected daily active user growth, an expanding Snapstar influencer program, and a surge in Snapchat Plus subscriptions. Snap is still down 19.4% year-to-date and trading nearly 50% below its 52-week high, making it a tempting but volatile pick. The big question: can it turn engagement into sustained revenue growth? Investors looking for stability might tread carefully, but those who believe in Snap's long-term potential in the social media and digital advertising space may see today's dip as a chance to buy in before the next big move. Our review on HOOD. Robinhood Markets Incorporated is shaking up the financial world once again. Known for making investing accessible to the masses, Robinhood offers everything from commission-free trading to crypto, margin investing, and now, event contracts. And its latest move? March Madness prediction markets. Are these just sports bets in disguise, or is Robinhood pioneering a new financial product? This isn't Robinhood's first attempt at blending finance and sports. Earlier this year, it rolled out Super Bowl contracts, only to face regulatory pushback from the CFTC. Now, with March Madness in full swing, Robinhood is doubling down, launching new contracts that let users speculate on NCAA basketball outcomes. The key argument from Robinhood? These aren't bets. They're market-driven contracts where users trade against each other rather than the house. More like hedging than gambling. But not everyone's buying it. Critics, including the American Gaming Association and Major League Baseball, argue that this is just a backdoor into the multi-billion-dollar sports betting industry, without the same regulatory oversight. Meanwhile, the CFTC, the regulatory body overseeing event contracts, seems to be shifting its stance. After initially requesting Robinhood pull its Super Bowl contracts, it now says there's no legal reason to stop these March Madness contracts from going forward. The big question is whether other brokerages will follow suit. Some, like Interactive Brokers and Webull, have been hesitant, keeping their event contracts tied to politics and economic events. But if Robinhood proves there's a market for sports-related contracts, others may not want to miss out. For investors, this is a space worth watching. If the CFTC officially embraces sports event contracts, it could open a whole new category of speculative trading. Whether that's a good thing or just financial markets creeping into the world of sports betting depends on your perspective. One thing's for sure, Robinhood isn't backing down from a fight, and where it leads, others often follow. Our review on PDD. PDD Holdings Inc. is making big moves in the e-commerce world, and its latest earnings report shows just how fast it's growing. The company, which owns platforms like Pinduoduo and Temu, is all about connecting buyers, merchants, and brands through a digital-first shopping experience. And judging by these numbers, that strategy is paying off. PDD just posted a 24% jump in revenue for Q4 compared to last year, fueled by strong demand in online marketing and transaction services. Profits are up too. Operating profit climbed 14%, and net income rose 18% for the quarter. But the real headline? For the full year, revenue shot up 59%, with transaction services surging a whopping 108%. That's serious momentum. Of course, growing this fast comes with costs. PDD ramped up spending on sales and marketing, but even with those higher expenses, operating profits still soared 85% year over year. That tells us PDD is scaling efficiently while keeping profitability in check. Looking ahead, management is sticking to its playbook, investing in platform expansion and strengthening its ecosystem for merchants and consumers alike. Given how well the company is executing, it's no surprise investors are taking notice. With shares climbing nearly 4% after the earnings release, the market clearly likes what it sees. Our review on RIG. Transocean Ltd is a major player in offshore drilling, providing contract drilling services to oil and gas companies worldwide. With a fleet of high-spec rigs, the company specializes in deepwater and ultra-deepwater drilling, positioning itself as a key partner for energy exploration and production. The latest update from Transocean has investors taking notice. The company just secured a fresh contract for one of its ultra-deepwater drill ships, adding another multi-year deal to its backlog. That's a big deal because backlog, essentially future revenue that's already locked in, is a crucial metric for offshore drillers. More contracts mean more stability and visibility into future earnings, something investors always want to see. On the financial side, Transocean has been working to manage its debt while capitalizing on the rising demand for offshore drilling. With oil prices staying relatively strong, exploration activity is picking up, which plays right into Transocean's strengths. The company has been securing higher day rates for its rigs, signaling strong demand and improving profitability. Looking ahead, the big question is whether the offshore drilling market continues its recovery. If oil companies keep pushing ahead with deepwater projects, Transocean stands to benefit. For now, the latest contract win reinforces the company's steady positioning in a cyclical but potentially rewarding sector. Investors watching the energy space might want to keep an eye on how Transocean continues to stack up contracts and manage its financials in the months ahead. Our review on TSM, Taiwan Semiconductor Manufacturing Co. Limited is the world's go-to chip maker, producing cutting-edge semiconductors for everything from smartphones to data centers. As the dominant player in advanced chip manufacturing, TSMC's technology powers the biggest names in tech, including Apple, NVIDIA, and AMD. Now, about that recent Intel situation, NVIDIA CEO just threw cold water on the idea of TSMC taking over Intel's struggling foundry business, and the market reacted fast. Intel stock took a hit, but what does this mean for TSMC? In short, not much changes. The idea that TSMC would swoop in and absorb Intel's foundry operations was always a bit of a long shot. While Intel has had its challenges ramping up advanced chip production, TSMC has remained laser-focused on leading the industry with its 3 nanometers and 2 nanometers nodes. Investors shouldn't get too caught up in the headlines here. The bigger story for TSMC is its long-term dominance in the foundry business, and that remains intact. Demand for AI chips is skyrocketing, and TSMC is the only manufacturer capable of producing NVIDIA's most advanced GPUs at scale. Whether or not Intel sorts out its foundry business, TSMC's role as the industry leader isn't changing anytime soon. Our review on BE. Bloom Energy Corporation is all about redefining clean energy with its advanced fuel cell and hydrogen technology. The company's energy servers and electrolyzers are designed to provide reliable, low-carbon power for businesses and utilities, and with over 1.2 gigawatts already deployed, they're proving to be a serious player in the energy transition. Their solid oxide platform is flexible, serving industries from utilities to heavy manufacturing and even marine fuel applications. Now, let's dive into what's been moving Bloom Energy stock lately. The hydrogen economy is full of potential, but investors are still weighing how quickly it can scale. Bloom's technology positions it well for the future, but Wall Street is watching for stronger financial execution. Recent earnings have shown solid revenue growth, but concerns remain around profitability and how efficiently Bloom can ramp up production while managing costs. One major factor? Government incentives. Clean energy policies, especially in the US and Europe, could play a huge role in accelerating demand for hydrogen and fuel cells. Bloom is in a great spot to benefit from these tailwinds, but competition in the sector is fierce, and execution is everything. Investors want to see stronger margins and clear signs that Bloom's technology is gaining traction at scale. At the end of the day, Bloom Energy is operating in one of the most exciting spaces in the energy sector. The long-term growth story is compelling, but it's still a company in transition. If it can prove that its technology is both scalable and profitable, patient investors could see significant upside. But for now, it's all about watching the execution. Our review on QXO. QXO Incorporated is making waves in the tech world with its latest move to acquire Beacon Roofing Supply, a major distributor of roofing and exterior products. If you're not familiar, QXO specializes in ERP systems, software solutions, and consulting services for industries like manufacturing and distribution. Now, the company is shifting gears and diving into the roofing sector with an $11 billion all-cash tender offer for Beacon, which operates nearly 600 branches across the U.S. and Canada. The offer, set at $124.35 per share, has already garnered attention, with both QXO and Beacon shares climbing. QXO's got the financial backing to make this happen, securing $5 billion in cash plus another $830 million from institutional investors to fund the deal. This is a significant move for QXO, potentially expanding its footprint in a new, stable industry with a reliable revenue stream. Beacon's board is on board, recommending shareholders tender their shares, and it's clear they're seeing the value in the deal, an immediate cash premium in uncertain times. This acquisition could open up a lot of opportunities for QXO, but it's going to be interesting to see how they integrate Beacon and leverage its existing operations to fuel future growth. For investors, this is definitely one to watch as the deal progresses. Please subscribe, give the video a like, and watch more from our playlist. Thanks.